Good morning, good afternoon, good evening. Welcome to the Tuesday, the 19th of April, Bull versus Bear webinar with Trade Day. Steve Miley here on the call. Welcome, everyone. We'll go through our usual regular run through in here today. Calendars. What's going on the macro calendar, what we've got coming up on the earnings calendar for today. We'll take a look at the some articles, some headlines from the major news wires. What's impacting markets right here, right now, from a macroeconomic, fundamental, geopolitical perspective. And we'll also take a look at some charts, see where there are some opportunities on the major markets that I know you guys trade, S&P, NASDAQ, gold, oil, and we'll take a look at the treasuries as well, see what's, because they're very much the dog that's wagging the tail of many of the other markets at the moment. So we'll kick off in here with the data. On the data side, very light today, super light today. In fact, nothing to really speak of that's going to have any impact on the market, any of the markets we're probably trading. So maybe the API weekly crude oil stock, obviously for oil, but that's really not having a significant impact right now on markets with everything that's going on in the global economy. So but I mean, probably watching out for that if you are trading oil. But outside of that, there's nothing in here that's going to really pique our interest going through today. On the earnings calendar, more interesting. I've already filtered this down to just the major, the big stocks that are reporting today. We've already had Johnson & Johnson. We had a miss, not a big miss, only a slight miss here on the revenue, and a beat on the earnings per share. And then we've already had Lockheed Martin as well. Again, similar miss on the revenue, beat on the EPS. And then down here, probably not going to, these guys down here, not going to probably impact too much on the wider indices, which we're interested in. I think the real focus we're going to be on Netflix. Any negative impact on inflationary pressures, any negative impact coming through for Netflix in here to the US and global consumer. We get those after the market closes today. Okay, so hopefully after you guys are out of positions, but nevertheless watching the price action from that after the bell today. Let's take a look at 5 things to start your day in here. So we do, and I've got a little thing in here as well on Tesla, or actually maybe a little bit further along. Yeah, no, further along from Reuters, I think. But yeah, so nothing really massive in here. I mean, to talk about on the Russian billionaires, Putin meeting with big business owners today. In here, the Japanese yen, this is significant if you're trading the dollar, obviously, and the Japanese yen continues to weaken in here, with the Bank of Japan staying very, very dovish, and obviously the Fed being very hawkish. So the yen losing ground across the board to most currencies. Is not just the dollar, but particularly against the dollar, with the dollar strong against most currencies over the past week or two, and with the more aggressive rate hike indications coming from the Fed. And even though we've had Suzuki in here, the finance minister, trying to do a verbal defense of the currency, it's gone through 128 against the dollar yen up through 128, and it's at its biggest losing streak in at least 50 years, and at 20-year highs for dollar yen. So 20-year lows for the yen. In here, we're going to see continued rotation out of growth stocks into value stocks, out of emerging markets into developed markets. So we'll continue to see that, and it'd be interesting to see how much that continues. I mean, from what I can see, I think that trend though is fading slightly in here. So maybe we're coming towards the end of that rotation. Maybe there's value now in some of those growth stocks that have fallen significantly. We'll talk about this in a minute, just where the markets are placed in here at the moment. And we did have, I mean, it's not actually picked up on here, but well, it does say it right at the top. I don't know why they're not. But yesterday, Bullard talked about a potential for a 75 basis point hike. And I just got that in here. So Fed Bullard says 75 basis point hike could be option if needed. Now, do remember, I'm going to go to the Hawk Dove sheet. Remember, this is from itcmarkets.com. In here, their Hawk Dove sheet. You can Google that and find that. Remember, Bullard, look at where he is. Down here, he is the most hawkish of the hawks. Okay, so no surprise that Bullard, the hawkish of the hawks, is calling for a potential 75 basis point hike if needed. And obviously the market not particularly moving aggressively on that. You know, if someone in the middle ground, if a Dove had said that on their sheet, if someone in here had said that, or someone certainly up here, had said that, it would have had a bigger impact. But when a hawk says something particularly hawkish, not as big an impact. It doesn't mean though that if we go in here and see just this headline from, so the bond selling resumes, 10-year treasury yields near 2% 2.90%. And I'm just going to quickly look here, and you can see in here, having dipped and rebounded yesterday. It was a quite a lackluster rebound in the end. Didn't build on that yesterday. Having had the significant sell-off back on Thursday. Remember, closed Friday, tried to rebound yesterday and looked back down right on the lows. And remember, this is low prices equals high yields. Okay, so if I quickly go to where are we in? Is it on the investing? It's usually in the investing. Here we go. Just let this chart load up. So here's the 10-year yield chart, and if I put it onto so you can see actually on the yield chart, actually going to new high yields in here, and we've just pipped up to what's the high yield for today is 2.907. So we've actually broken through 290, 3% now in the spotlight for 10-year yields. So yeah, we've still got significant higher yield pressures coming through, and obviously remember that's negative for growth stocks, negative then for potentially for the Nasdaq compared to it's negative for all stocks, but negative more for growth stocks and value stocks. So we have seen, if we look at the charts, we've seen a certain outperformance in here. If we go and take a look at just the first of all the S&P in here, with S&P sitting around 50% down from the March rally. If we looked at this yesterday, look at the Nasdaq, it's down at 61.8% retracement of the March rally. And if you look at the Dow, I don't think I've got the retracement on in here. If we look at the Dow, get rid of this old analysis in here. And we put the Fibonacci retracement on of the March rally. So I'm going to take it from here. I'm going to go right to the March low. And you can see we're not even down at the 50%. In fact, we're hovering around the 38.2%. And remember, the Dow's got more value stocks in it, right? Fewer of those growth stocks in here. So the Dow outperforming the S&P effectively with respect to how much it's retraced of the March rebound. And then also certainly, and then both of those outperforming the Nasdaq. Let's go back to a few of the headlines in here. So yeah, Bullard speaking yesterday. Stocks futures fall as yields climb. Well, yields did climb. We've already mentioned that. Yen tumbles again in here. We've covered all of that in here. European stocks drop after Easter break. Remember, Europe was closed yesterday. And if we go take a look at the European stock indices, you can say playing a little bit of catch up to the downside, having been closed on Monday. So we're anywhere down between about 1/3%, 0.4% in here about for the FTSE. But, some of these down, the French index down and just over 1%. The DAX, the German index down just under 1%. Paying a little bit of a catch up from some of the weakness that we saw yesterday from the US stocks. Having the US stocks, remember, rebounded, then faded. The Dow was down like 1/10. S&P was pretty much unchanged. The Nasdaq was down a bit more, significantly more than that. But the US stocks in here this morning relatively unchanged. We're not particularly low in here. Let me just refresh this chart. But we've not got a significant effect. Look, at the moment we're sitting pretty much unchanged. I just refreshed there. Just 0.0 something either up or down. So pretty much sitting unchanged going into today. Let's just go run through a few more headlines. European stocks down. Yen hits 20-year high. 20-year low. Dollar yen hits a 20-year high as US hikes loom, and we've already covered all that. This is all old news, nothing really new in here. Dollar steadies after hitting fresh 20-year high, and yen, old news. Here's the Tesla article. So Tesla earnings under pressure. So remember, got Tesla coming up. If we go and look in here on the earnings calendar, Tesla's tomorrow. Okay, after the bell tomorrow, we have Tesla. And Tesla in here tomorrow. That can have a significant impact, Tesla, on the broader indices, particularly in the Nasdaq. And Tesla in here under earnings potentially under pressure from Shanghai factory. Remember, big lockdown in China, in Shanghai, and they have a factory there. And so potentially that could be disruptive for Tesla. So we'll be watching out and covering that tomorrow. And again, we'll really look to this 10-year yields near high. Let's look at the CME Fed Watch tool. Well, this is the June. I was looking at this early just before we came on. We've spoke about this already. The main meeting now nailed on for a 50 basis point, only a 9% chance of only a 25 basis point, a 0.25% rise, nailed on pretty much for a 50% rise, a 50 basis point rise, not 50%, sorry, 0.5%. And then 61.7 there for another 50, with only 6% chance of only a 25 at the following meeting. And now, you know, a 32.5% chance that they go even more. So this is then here, remember, we're currently at 25 to 50. This is saying we're going to be up 125. So there's a third chance in here, a 1 in 3 chance for by the June meeting. We've had a 50 and a 75. So yeah, the market's getting very, very hawkish there. Personally, this is very much a personal view in here. I think we're reaching, you know, we had the CPI data out last week, remember, from the US, you know, higher than expected. I think we're reaching like peak inflation, peak hawkishness. Okay. I don't know how much hawkish the Fed are going to be, right? They're going to want to wait now and see how the inflation data develops. Unless inflation data really starts to accelerate above 10% to like 12%, 13%, they're not going to step more hawkish, in my opinion, than they currently are. I think we're reaching kind of peak inflation and peak hawkishness. Now, it doesn't mean that inflation is going to drop. It could just peak out around, you know, depending on if we're looking at the US or the UK numbers or European numbers, it could peak out at like 6, 7, 8% and just stop there and just stay up there. Now, that's not good either. They want to try and get it down from there. But then that doesn't mean they're going to become even more hawkish. If it peaks out there and just starts to drop off slightly and stabilizes around those levels, then you might see that the Fed step away from this ultra, you know, I would say we're very, very hawkish. You know, in literally a couple of months, we've gone from being relatively hawkish to now very, very hawkish. And I don't think the Fed's got much more hawkishness in it. So they're going to want to wait and see how this plays out. Even the hawks amongst the Fed. I know that Bullard's just said 75, but Bullard's not saying, you know, 75 at every meeting. So yeah, I think we're getting peak hawkishness. So there's a point that we're going to get to a point. I don't think we're far away from that. Just going back to the Treasury market here, the Treasuries start to hit, you know, we start to hit a level where, you know, we've already seen that. So this is a really aggressive move. We've seen lower in yields, so lower in price, sorry, higher in yields since pretty much the beginning of March in here, and obviously that move started even earlier back here. So this is like, you know, when the Ukrainian situations, that's the actually, I think Ukraine starts around here, yeah, 16th. Oh no, this is actually from December. Where's February? So Ukraine is around here. Okay, around here. Okay, the invasion. So, but the market in here, a really aggressive move low. But you can see it's being tempered. We had a rebound here a few weeks ago, another rebound in here last week. It looks like the market's trying to find value, and I do think we're going to bottom out in lower prices. We're going to peak out in yields, and so I think we're coming towards peak hawkishness and peak inflation numbers. So, and then you know, if we get a turn in all of this, that's going to allow stocks to rally back higher, in my opinion. Okay, so we could easily see, and you know, as traders, we want to be on that turn because that could be quite an aggressive turn. We could see, and I'm not saying it's coming now because obviously, look, as we just looked at, we're just hitting new higher yields right here on the 10-year. Okay, but it doesn't mean that this is not slowing, and that this may start to roll, and then that could give value into the stocks, into the growth stocks particularly, and then we could see a significant rebound. Let's take a look at some of those charts. But at the moment, still, you know, looking fairly negative. You know, we did get that hammer pattern yesterday from the S&P, but the market, you know, significantly lower. Remember, this was in pre-market. From the holiday weekend, pre-market sell-off, and then it had already rebounded when we were on the call yesterday, and then pretty much just opened and closed early unchanged. We did dip lower. We're going to come and look at that and rebound again though. So it dipped during pre-market, then rallied, then dipped again once the market was open, and then rebounded. Okay, now we are lower again slightly in here this morning, but if we step in and look at the 1 hour chart on the S&P, so there we are. There's the sell-off in here. So that was in the pre-market down to here. We rebounded. It went lower. Actually went lower again twice. But once rebounded, twice rebounded, lower again, and trying to rebound again. So we're kind of eking out a base in here. Now, you know, I'm loath to be bullish on this because it does all look still weak. And obviously with the treasuries, with treasuries under pressure, you need to, again, keep an eye on these treasuries. Look, treasuries did make a new low in here. But look, now trying to stabilize. If treasuries push back into here, you've got potential for a little bottom in here. Okay, so keeping an eye on the treasuries. You know, I think at the moment you kind of have to play this. Yesterday we said actually on the S&P, you know, looking for a bounce. We got the bounce. and then maybe sell into it. And we got the bounce, and then you could have sold into it, and then you got a bounce again, and you could have sold into that again. We've got a bounce again. I think there's risk for another bounce in here. Whether you sell into it, I'm not quite sure. If it goes straight south in here on the equity market open, if we go straight south and we start breaking down through this low in here that we just posted over the last hour, or this low in here from the actual low of the whole move, if it starts breaking down there, then yeah, you're short, right? 100% you're short. But at the moment, it looks like it's trying to maybe eke out a base. And it's a similar story. If we look at the daily on the NASDAQ in here, you got the hammer pattern held, below the 61.8, rebounded. Today went down to the 61.8, rebounded. And again, in here, if we step into the 1 hour chart, there's the initial move lower. Then once we opened, this was the cash market yesterday. Lower, we rebounded after this is the overnight activity. We rebounded pre-open, and then on the open, and continued to rebound on the open, and then we went lower and then back higher and then lower again and then back higher. It was a relatively healthy close compared to where we'd been. Remember, it actually closed, I think, down or pretty much flat on the day, and then we've gone lower again this morning, but trying to rebound again. If it breaks below this low here, if it breaks below this low here, if it breaks below the low in here, it looks more bearish, but it looks like it's trying to form a base. So I think, you have to just be a little bit flexible once we go onto the cash market open. Let's take a look, and then I'm going to wrap up at the commodity markets in here. I'm going to kick it off in here with, while we're on it, with the oil chart. So oil, we said yesterday bullish. It already rallied though. It did end up setting back, and then this morning kind of hesitant, choppy in here. Now you could argue quite easily that's a head and shoulders top, right? Now obviously if oil rolls lower as well in here, remember we do have that data in here today, the US data. So you could argue in here we've already set up in here a head and shoulders top, yeah. Or you could argue that it's actually through here and it's already completed the head and shoulders top. That is actually through kind of the line through there, right? It's not the best. Okay, shoulder here, is that the head, and this is another shoulder over here? We've already broken it, or do we redraw it through here? Do we need to wait for the break here? If oil does break low and we get this head and shoulders top, oil lower is going to be probably, although we've had a dislocation now, we're certainly in a point of a dislocation between, about 2-3 weeks ago, and we certainly saw oil up, stocks down, and vice versa. Okay. At the moment, though, that kind of not so strong a correlation, but we have seen oil up the last few days, and we've seen stocks obviously down. Okay. So if oil starts to roll back lower, if we start to see oil breaking back down in here and push back down into this area here, and then we could easily see that being positive for stocks. Let's take a look at gold. So gold in here stayed strong, okay, through the beginning of the week, and then we get this failure pattern in here, okay. So again, risk, because we're kind of still in a risk-off scenario, gold being bid up in risk-off scenario is a safe haven, but a big failure. This is a shooting star candlestick, a really negative candlestick. Now, if we go into the 30-minute chart in here, there's the failure up there. And I would say if we just break down below the current low, below the low of today, which I've got at 1975.6, down through there looks really negative. Certainly down through this low over here, 1962. Where are we? 1962.7 looks super negative, yeah. But I think even below this low in here, this starts to look like a little bit of a topping pattern, and it would certainly reinforce what we're seeing on the daily chart. Get back down through. So yesterday's low, that is 1974.4, yeah. Down through yesterday's low would kind of start to confirm that as a shooting star candlestick, and then we quickly aim down for that 1962.7 level, or maybe deeper. Okay, if it undercuts that, we could see a significant sell-off. So watching out for gold as well. Again, these markets in here, the gold and oil look like they're potentially topping, and stocks in here potentially very vaguely basing. But I mean, I'm not tying myself to that one. I'm going to wait to see what happens on the cash market open. All right, guys, I'm going to wrap it up there. I'm going to, as ever, wish you all a great trading day. Stay safe. I'll be back with you with another Bull versus Bear webinar tomorrow on Wednesday. Bye.